oil back in the mid-90s, real yields at cycle highs, and an AI spending boom all colliding at once. Cross-asset correlations are shifting right as positioning looks stretched. Welcome to vTalkInsight, Allocator's Lens Daily for July 23, 2026. Let's start with equities, where those tensions are most visible on the surface. In equities, the big picture is a tug-of-war between powerful earnings momentum and a growing list of macro and valuation headwinds. Headline indices remain close to highs, and the volatility index is only in the mid-teens. Yet beneath that calm we see rising oil prices, higher real yields, and very aggressive positioning that leave the tape fragile. The earnings backdrop itself is undeniably strong. Second quarter profits for the S&P 500 are projected to rise close to 30%, one of the fastest clips in decades outside of recession rebounds. Around 9 in 10 companies are beating expectations, and the growth is broadening beyond AI and semiconductors into financials, industrials, healthcare, and even telecoms, with firms like Wells Fargo, Santander, Airbus, and AT&T all reporting robust top-line or margin trends. At the same time, leadership is quietly rotating. The so-called Magnificent Seven and the hyperscalers have lagged this year, while small caps, value, and quality defensives such as utilities and healthcare have started to outperform. Energy stocks are leading in Europe and low volatility. High dividend names have historically cushioned portfolios when tech sells off. Yet ETF flows show these diversifiers remain underowned, and breadth within the S&P is still narrower than a healthy bull market would suggest. The AI complex is where optimism and risk collide most clearly. Cloud and AI infrastructure demand is exceptional, with Google's cloud business growing at multiples of the index and AI server suppliers like Supermicro reporting record backlogs and margin upgrades. But hyperscalers are embarking on trillion-dollar capital spending plans that could leave free cash flow negative for years, and recent corrections in semiconductor stocks highlight how quickly richly valued levered AI trades can mean revert when expectations wobble. Positioning amplifies all of this. Long-only sentiment is as bullish as it was in the reopening boom. Retail call buying is elevated in mega-cap tech, and leverage in AI and semiconductor names has been extreme. Single-stock volatility around upcoming earnings for firms like Alphabet, Tesla, and others is at record highs versus index vol, meaning stock-level shocks can transmit quickly into indices if crowded trades unwind, especially if rising yields or further energy spikes challenge the growth narrative. Turning to rates. The dominant theme is higher for longer. Nominal Treasury yields sit near their peaks for the year, with the 10-year around the mid-4% range and real yields over 2%, the highest since 2023. Global benchmarks tell a similar story, and that repricing is driven less by runaway inflation expectations and more by persistent energy costs, sticky price pressures, and mounting concern about fiscal deficits and war-related spending. Policy expectations are finally balanced. Some market commentary now talks about several additional Federal Reserve hikes this year, as oil holds near the mid-90s and headline inflation risks re-accelerate. Yet the curve is only pricing a little more than one move, and a growing camp argues that hiking into an energy shock does little to fix the underlying problem, which may keep the Fed on hold even as rhetoric stays hawkish. For allocators, the key question is what this means for bonds as both a source of return and a portfolio hedge. On the positive side, starting yields are finally compelling. The broad U.S. aggregate index now offers close to 5%, and many high-quality fixed income portfolios can earn 5 to 7% coupons. Historically, that level of carry has delivered positive one-year outcomes in the vast majority of rising rate environments, even when price returns were negative. The challenge is that bonds are not behaving like the reliable shock absorber they once were. Credit spreads are still tight. Equity-bond correlations have risen as AI-driven capex and issuance link the two asset classes, and 10-year yields approaching 5% have previously coincided with stress for equity valuations, especially in long-duration growth names. That puts a premium on understanding not just the level of yields, but the speed and drivers of any further move from here. In credit, index-level calm masks growing pockets of concentration and complexity. High-yield benchmarks have outpaced many other assets this year, and yields across the quality spectrum look appealing in absolute terms. However, spreads remain tight and valuations are far from distressed. So much of the return profile now comes from clipping coupons rather than expecting further spread tightening. A notable development is how much new issuance is coming from AI-exposed sectors. Investment-grade markets are increasingly dominated by hyperscalers, data centers, and semiconductor companies, which together account for a large share of new bonds. These issuers currently enjoy strong business momentum, but multi-year, trillion-scale AI, CAPEX plans, and the prospect of negative free cash flow raise legitimate questions about long-term bondholder risk if growth or monetization disappoints. On the positive side, strong balance sheets in many large corporates, especially in technology and banking, are mitigating default concerns, and high-grade investors do not necessarily need to move far down the quality spectrum to earn solid yields. Private credit is more heterogeneous, with banks emphasizing disciplined counterparties and analytics. From here, watch how sustained high energy prices and rising real yields filter into weaker credits, where any widening in spreads is likely to show up first. In foreign exchange, the Japanese yen is the standout pressure point. The currency has traded near levels last seen in the mid-1980s, even after episodes of official intervention. Recent comments from the Bank of Japan signal a willingness to raise rates more quickly than economists had expected, and that shift has sparked a partial recovery in the yen. This tug-of-war between ultra-easy policy and a possible tightening pivot matters well beyond FX desks. The yen has been a core funding currency for carry trades into higher-yielding assets, so any decisive BOJ move could force investors to reassess leverage positions across equities, credit, and emerging markets. Some strategies now discussed include favoring the yen against currencies more exposed to commodity cycles and less hawkish central banks, such as the Canadian dollar. Looking ahead, the key variables are how quickly the Bank of Japan actually tightens and whether it coordinates with other policymakers. A sharp policy surprise could generate a spike in volatility, particularly if it coincides with stress elsewhere, such as a renewed leg higher in global yields or oil. For multi-asset portfolios, yen behavior is increasingly central to assessing both tail risk and diversification, which brings us naturally to the commodity shock, driving much of the macro debate. Commodities remain the primary transmission channel from geopolitics into inflation and cross-asset pricing. Brent crude has jumped by roughly $20 in just a few weeks, trading in the mid-$90 range as Middle East tensions escalate. Concerns span everything from Iranian negotiations to threats against shipping routes in the Red Sea and the Strait of Hormuz, while refined products like gasoline, diesel, and jet fuel face rapidly depleting inventories and crack spreads at multi-year highs. This energy squeeze is already feeding back into inflation expectations and policy debates. Some large banks now warn that a further escalation could push oil into triple digits, potentially toward the $100 to $120 area, which would complicate the Federal Reserve's task and keep global yields elevated. Europe looks particularly exposed, with gas storage well below seasonal norms, a heavy reliance on liquefied natural gas imports, and a significant share of global LNG volumes transiting through geopolitically sensitive choke points. Beyond energy, industrial metals tell their own story. Copper prices remain supported by strong demand from defense spending, data centers, and electric vehicles, and longer-term supply constraints underpin a constructive structural view. In the nearer term, high inventories in some regions and uncertainty around U.S. tariffs mean a resolution of trade tensions or destocking could trigger bouts of weakness, even if the multi-year demand narrative stays intact. Gold has also reasserted itself, rising more than 20% over the past year and increasingly being framed as in the early stages of a new bull phase. Persistent central bank buying and steady private demand support that thesis. The traditional inverse relationship between gold and real yields is re-emerging, but deepening concerns over fiscal deficits and the limits of bond market safe haven demand means some of the classic relationships between treasuries, bullion, and risk assets may continue to evolve. Stepping back, the cross-asset picture is one where an energy shock and higher real yields are pressing against a powerful, AI-infused earnings cycle. Equities still enjoys strong profit growth and a broadening leadership mix, but stretch positioning, single stock volatility, and expensive tech leave the balance of risks more two-sided. Rates now offer meaningful income, Yet the combination of sticky inflation, fiscal worries, and tighter equity bond linkages means traditional diversification is not guaranteed. Credit remains a carry story with growing concentration in AI-related issuers, while the yen's policy inflection and renewed strength in gold and oil remind us that policy divergence and geopolitical shocks can reshuffle correlations quickly. For allocators, the key watch points are the path of oil and gas into winter, the trajectory of real yields, the tone of upcoming big tech earnings on AI monetization, and any concrete shift from the Bank of Japan. How those four levers move together will do much to define the opportunity set across assets over the next quarter. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.